Is the U.S. housing market on the brink of a collapse even worse than 2008? Some analysts are sounding the alarm, and what they're saying is deeply concerning. They're predicting a slow-motion crash that could see home values plummet by as much as 50%. If you're a homeowner, a renter, or an investor, you need to hear this. You might be seeing headlines about strong new home sales and thinking everything's fine. But according to analyst Melody Wright, that's a mirage. She argues the market is essentially frozen, artificially propped up by builder incentives and desperate measures. When you look at the real picture, combining both new and existing home sales, the numbers tell a very different story. August 2025, for instance, is shaping up to be one of the weakest months for total home sales since 1999. The only time it was worse was during the absolute bottom of the post-2008 crisis. This isn't a sign of a healthy market. It's a sign of a market on life support. So, why are we hearing these dire warnings now? Let's rewind to 2008. That crash was triggered by a subprime mortgage crisis, leading to millions of foreclosures and wiping out trillions in household wealth. It was a sudden, violent shock to the system. Today, the problem is different, but potentially more dangerous. Wright and others believe the structural issues are deeper. It's not just about bad loans. It's about a fundamental and unsustainable gap between what people earn and what houses cost. The market isn't just sick, it's been chronically ill for years, and the fever is about to break. The key date everyone is pointing to is 2026. Wright forecasts that by the second quarter of 2026, we'll hit a tipping point. This is when the long-standing disconnect between median household income and median home prices will become impossible to ignore. For years, low interest rates papered over this problem, but now that's over. As reality sets in, a massive correction will be needed to bring prices back in line with what average Americans can actually afford. This isn't a minor dip we're talking about. This is a potential halving of property values in some areas. Imagine the home you bought for $500,000 suddenly being worth $250,000. That's the scale of the correction being discussed. This won't be a uniform event. Some cities will be hit harder than others. Current analysis suggests that home prices will start to dip in at least 22 of the 100 largest U.S. cities as we head into 2026. And while mortgage rates might ease a little, it won't be enough to solve the core affordability crisis. The strain is becoming too much for the market to bear. We're not just talking about bubble cities like Austin or Phoenix. This will be a widespread phenomenon. So what does this mean for you? The risks are immense and touch every corner of the economy. For homeowners, especially those who bought near the peak, the risk of losing your hard-earned equity is very real. You could end up underwater on your mortgage, owing more than your home is worth. For real estate investors, the picture is also grim. A collapse in property values could decimate your portfolio. Rental yields might plummet as the market gets flooded with desperate sellers and newly built inventory. You could see your cash flow dry up almost overnight. And it doesn't stop there. Think about the banks and lenders. A wave of defaults and foreclosures could put immense strain on the financial system. We saw how this played out in 2008. And while regulations are stronger now, no system is unbreakable. A severe housing crash would inevitably ripple out into the broader economy. Consumer spending would seize up as people see their single biggest asset, their home, lose value. The construction industry would grind to a halt, leading to widespread job losses. The economic fallout could be severe and long-lasting, affecting everyone, not just homeowners. Let's do a quick, sobering comparison to put this in perspective. In the 2008 crash, home values fell by about 30% on average nationwide. The forecast from analysts like Wright suggests a potential drop of up to 50% this time. The 2008 trigger was the subprime mortgage crisis. The 2026 trigger is expected to be the fundamental mismatch between income and prices. The timeline is also different. 2008 was a sudden collapse that unfolded over about 2 years. This is being described as a slow-motion crash that has been building for years and will finally tip over in 2026. But the impact on households, the risk of foreclosures and wealth evaporation is just as real, and potentially even deeper and more painful this time around. So, what's the bottom line? We're not trying to spread panic, but to share a credible, data-backed warning from seasoned analysts. The consensus among this group is that the U.S. housing market is not heading for a soft landing. It is heading toward a slow-motion crash that will culminate in a dramatic and painful correction by 2026. If these forecasts hold true, the coming downturn could surpass the devastation of 2008 in both its depth and its duration. This isn't just an abstract economic forecast. It's a potential reality that could reshape your financial future. It's crucial to be prepared, to understand the risks, and to make informed decisions. We'll be following this story closely and bringing you updates and strategies on how to navigate these uncertain times. Make sure you're subscribed so you don't miss out. Thanks for watching.